If you're a small business owner in Australia, your last tax return has already been through the ATO's risk profiling system. You won't get a phone call, you won't get a warning letter. Their data matching engine quietly cross-references your return against third-party data. Your bank, your card terminal, your suppliers, your property records, even crypto exchanges. If something doesn't line up, it gets flagged. Sometimes that flag sits there for years. Sometimes it triggers a review next week. You just don't know until the letter shows up. And when people hear audit, they picture fraud, someone faking invoices, hiding income. But the ATO doesn't need fraud to open a case on you. Most audits are triggered by a discrepancy. Your numbers don't match their data, or your business sits outside of the benchmarks for your industry. An audit can drag on for months. The accounting fees alone run into the thousands, and once the letter arrives, you've got 28 days to start producing records. We had a client last year, a plumber operating through a company, about 680K in revenue. He bought a $100,000 car 18 months earlier, paid from it from his personal account, but registered it in the company name. Then he drove it as his personal car. His logic, I paid for it, so it's mine. But the ATO's logic was that the company owns it, so the company has to account for it. Their data matching system pulled the registry record, cross-checked it against the company's return, and found a car the company owned but had never reported. One letter. By the time we worked through the unpaid FBT and penalties, he was looking at over $30,000, all identified through data matching. This video walks through the 5 triggers that flag returns most often, why they catch honest business owners off guard, and exactly what to check in your return before you lodge this year. The first trigger is the most common reason a return gets flagged, and it's got nothing to do with what you claimed or how much you earned. It's lodging late. And if your BAS or your tax return has been sliding, even by a few weeks, you're already on a list you don't want to be on. The ATO system flags late lodges automatically. Not sometimes, every time. And once you're flagged, the pattern sticks. It doesn't matter that you eventually got around to it. The record already exists. Now, the timing of when they actually contact you is unpredictable. It could be weeks, it could be 6 months, but the flag is instant. And you might be thinking, I've been doing this for years, no one said anything. That's not proof you're safe. That's the lag between being flagged and being contacted. The ATO batches and prioritizes. Your name sits in the queue until they get to you. So, lodge on time every time. That single habit puts you in ATO's lowest risk category. It sounds too simple to matter, but it's the first thing I'd check if any client walked in tomorrow and said, I want to make sure I never get audited. The second trigger is the one that catches people who think they're being careful, because the ATO's data matching system is pulling information most business owners assume is invisible. And if your reported income doesn't match what the ATO already knows about your life, you're going to get a letter. The ATO cross-references your return against land title records, property purchases, bank deposits, motor vehicle registrations. If you reported $120,000 in income, but you settled on a $2 million property, they want to know where the gap came from. Now, sometimes there's a completely valid explanation. Family helped you with the deposit, you received an inheritance, your spouse's income contributed to the purchase. All fine, but you need records to prove it. And you need them fast. The old idea of quietly building wealth while reporting minimal income, it's gone. The data matching is too sophisticated now. The ATO can see your lifestyle, and if it doesn't line up with your lodgement, they will ask why. So, if you can't explain the gap between your reported income and your asset position with clean documentation, you're exposed. The defense isn't a clever structure. It's having the records ready before anyone asks. The third trigger is the one from that plumber's story at the start. You're claiming a legitimate deduction, you've been doing it for years, and you assume everything is fine because no one's questioned it. But the documentation behind the claim has lapsed, expired, or was never right in the first place. And the ATO system catches the mismatch before a human even looks at your return. Now, one of the biggest areas we see this happen is when business owners pull money out of their company the wrong way. If that's something you're doing, or you're not sure whether the way you're extracting funds is actually compliant, we made a full video breakdown exactly what triggers a Division 7A issue and how to avoid it. I'll link it on the screen now. Motor vehicles are the biggest offender. If you're claiming business use on a car, you need a valid logbook, not one from 10 years ago, a current one. The ATO requires you to update it at least every 5 years, and it needs to genuinely reflect how you use the vehicle. Without a logbook, the ATO can deny the claim entirely or force you onto the set rates method, which almost gives you a worse outcome. Home office expenses are the same story. If you're claiming a portion of electricity or internet, you need records to show how you calculated the split. Not a guess, not, oh, it's roughly half. A method you can explain and back up if someone asks. We see this constantly. Business owners claiming things they're genuinely entitled to, but without the paperwork to prove it. The deduction is real, the evidence isn't. And to the ATO, that looks identical to someone making it up. So, before you lodge, check every recurring deduction and ask one question. Could I show the ATO how I calculated this today? If they asked, if the answer is no, fix it now. 20 minutes of paperwork versus 6 months of back and forth. The fourth trigger applies specifically to businesses that handle cash. Hospitality, trades, retail, services with cash paying customers. If there's a gap between what the ATO estimates you should be earning and what you're reporting, they have ways of finding out. There was a well-known hospitality venue that got hit with this a few years back. The ATO didn't trust the reported takings. So they sent an officer to sit outside the venue, counted customers walking in, estimated the average order size, multiplied it by the trading days. The gap between what they calculated and what the business had declared, about $1 million. You might not be hiding $1 million, but if you're running a cash-heavy business and your numbers look light relative to your location, your foot traffic, or your industry benchmarks, the system picks it up. And once it does, the ATO doesn't argue with your books. They build their own number from the outside. Then the burden is on you to prove them wrong. The ATO also watches for patterns around credit card surcharges and cash discounts. If customers are constantly paying less when they pay cash, that raises questions about whether all that revenue is being reported. So, if you run a cash business, your reported revenue needs to make sense relative to the size of your operation. It needs to be precise. And if there's a legitimate reason it looks low, like seasonal fluctuations or a bad year, that needs to be documented somewhere other than your memory. The fifth trigger ties all of this together, because even if you lodge on time, even if your lifestyle matches your income, even if every deduction is legitimate and your cash flow is fully reported, if your records are messy, you can't defend any of it when the ATO comes asking. Clean records means your bookkeeping is current, your bank feeds are reconciled, your receipts are stored, and your categories are accurate, genuinely accurate. Most people assume because they use Xero and the bank feed is connected, they're covered. Xero is only as good as what goes into it. If you've got 6 months of transactions sitting in Ask My Accountant, personal expenses mixed through the business account, or invoices that don't match your bank deposits, your data is fiction, and everything built on top of it, your BAS, your return, your deductions, is fiction too. 3 things put you in the lowest risk category with the ATO. Clean, detailed records, on-time lodgement, on-time payment. That combination is the most effective audit proofing strategy that exists. No structure, no loophole, no clever workaround comes close. We've seen clients with aggressive tax positions sail through ATO reviews because their records were immaculate. And we've seen simple sole traders with nothing to hide get hit with adjustments because they couldn't produce a receipt when it mattered. The ATO isn't hunting honest businesses. They're hunting patterns. Late lodgements, unexplained income, missing records, numbers that don't add up. Fix the basics and you stop being a target. That's the whole strategy. Boring beats clever every time. If you're watching this and realizing your books, your structure, or your tax position needs a proper review before you lodge, that's what we do. We work with business owners to make sure everything is clean, compliant, and set up to keep as much as possible. Links in the description. And if you want to keep going, we made a full breakdown on the exact ways to pull money out of your company without triggering a tax problem. That video's on the screen now. Otherwise, see you in the next video.